and then how to trade it. In this video, we will be looking at sell-offs, and in particular, the use of the upthrust. And we'll be looking at recent applications of upthrusts. And just as a general note, this is one of the very best Wyckoff trade setups to the downside. So you really want to know this. And as we move through the charts, we'll be discussing the all-important background conditions. You'll want to pay attention to these because it's the background conditions that pushes the odds of the trade setup. And this is true for any trade setup, but in particular, as we talk about specific applications with the upthrust, certain background conditions are going to push the odds of the trade setup in your favor. So you want to know this. And from this, we'll be able to see when upthrusts are most reliable and also when they're least reliable. During the course of the video, I'll be discussing the use of the Weiss wave and how it improves our ability to trade during sell-offs, and particularly how it helps us trade the upthrust. And we'll also be looking at intraday 5-minute tick charts and higher time frame charts like the 60-minute and the weekly charts. Before we get started, please be aware that this is my intellectual property. It is copyright protected. It is verified and protected by the DMCA, International Copyright Protection Act. Please use these materials only for your personal use. Do not reproduce them or share them on file sharing sites or distribute them in any way, even for free. And also, please be aware that we're not making trade recommendations or give investment advice here. This video is educational in nature, and neither I nor my company, Trading Psychology Edge, can be responsible for your trading. So please note that trading has a very, very high degree of risk, and you're encouraged to consult a certified financial advisor before making any investment or trading decisions. So what exactly is an upthrust? The market makes a swing high, rallies up and makes a swing high here at A. It then reacts down to B, and after reacting, it finds support and then heads back up towards the old high here back at A. And it reaches the high of A and actually pushes up a little through it, but it can't follow through to the upside. Instead, price falls back underneath the high of A and closes under the high of A, or under A's high. That's the upthrust. That's the setup. We short at that point or sell short at that point, and our target is a drive down or through and below the low at B. We're looking for a new low, a lower low in here. All right, so let's take a look at an example. So here's a recent example, actually a couple of examples of upthrusts in a sell-off in the S&Ps last month. I'm using a 3,000 tick chart where each bar represents 3,000 trades rather than say 5 minutes or 3 minutes. It's done by the activity of trades. And then the volume is aggregated. Why do I use a 3,000 tick chart? Because it's very good at giving me a sense of what went on in the overnight compared to say a 5-minute chart, which is very difficult to read. So you can see that the market made a high at A and reacted, then made a slightly lower high at B and then reacts down to C. Now it comes up to D. And we can draw a line across the top from B over to D, which I've done here in blue, and we see the upthrust in action. You can see that initially the first bar does penetrate the high at B and pushes up, but then the next two bars, either of which are the entry, both close underneath the high at B and then come down. Now, just to be clear, we have a high at A, we react, we'll call this A prime, then we come up to B, but look at what happens. B is actually lower. If we were to run this line across, it doesn't come all the way to the top. So this is not an upthrust. It must come to the top of the high, the swing high, the old swing high here at B. When it does, it fails to go higher. It fails to follow through to the upside and instead closes under the high. That's the signal to go short for this particular trade setup. So just as a recap, now sometimes when we get the upthrust, here we make a high at A, we react down to B, come back up to revisit the highs at A by penetrating slightly at C and then closing underneath. Well, sometimes, not always, but sometimes we will get a test occurring after the upthrust. This will be a weak rally of maybe 1 or 2 or sometimes more bars, but the volume will be low and the price action will be test-like, as you will see in a moment. And here, back to our chart, we see that the upthrust occurs at D here. We pull down a bit. Notice the high volume coming in here. This is supply or selling coming into the market and swamping any buying or demand. We would call that selling overcoming the buying. We come back to yesterday's high, which would be natural support. But now look at the rally back up. We get a weakness in here. There's some shortening of the thrust. There's poor close here. And one of the keys is that on the wave up, the volume is really low. That's a test of an upthrust, a picture-perfect test, and you can go short on this little key reversal, indicating that the rally is now over. Key reversal being a bar that rallies up above the high, but can't hold it, and comes back down and closes on or close to its low and well inside the prior bar, and certainly below its high. So that would be a nice test. Also, either an opportunity to add to your position or to initiate the position if you hadn't done it earlier. So we'll continue with this market, with this chart rather. The market drops down to E, rallies up, back up to yesterday's high, finds resistance there, and pushes down to G. Not a tremendous amount of volume. So we rally back up to H, which again is occurring at larger time frame resistance, yesterday's high, and what do we see? We get an upthrust there. The high at F, the swing high at F, we get the reaction down to G. Now we come back up trying to push through that swing high at F, but again, look at the volume. It's low, compared to the volume that we saw over here earlier in the day, rallying up, and even before the US market opened into the Asian and European markets, we see good volume there, but we don't see it here. So that is a low volume rally. We get the key reversal bar, a fine one to enter on. That actually gets a little bit of a test on its own. This upthrust gets tested again, if you can see that in there, a lower time frame, and then the market continues on down from there. And so we see the test labeled here. There's a short opportunity available there as well. And we continue on down. Again, we see the high volume coming in. This is supply over demand or selling over buying. Again, we get a weak rally up to J. This is not an upthrust or a test, just a weak rally in a downtrend. And remember, from our initial upthrust up here, initiated at D, the target was a push down through C, all right, the swing low at C. And here we get it. We come down again, we have that high volume, so selling is outstripping demand or buying, no question about it. But then look at what happens. We push down again here at L and then try to push down again at M, and the supply just dries right up. So here's where we would exit, or we would cover our trade. It's about 11:45 or so in the morning, right about time for the noon hour to kick in, and we will typically get a counter trend rally. If we've had a trend in the morning, which we do here, in the S&Ps, about noontime we'll tend to see the market back up and change direction a little bit. Normal considerations for the S&Ps. So just before we leave this chart, I want to just review background conditions here. We have supply coming in for a nice test. That's a good confirmation of the upthrust. We make lower lows going in, an upthrust against yesterday's high, which would be resistance, higher time period or higher time frame resistance. That's important. So when an upthrust occurs like that and we have these background conditions where we have supply coming into the market and an inability to go higher, that's a nice short. Again, it gets tested on low volume, giving you more confirmation. Then the supply comes in, again, as it did here, similar to what we saw back here at the beginning of the upthrust. So we get a bit of a weak pullback, weak being in terms of both price action and volume, and then we drop down. This gets a little climactic. We could draw trend channels in here if we wanted to. I didn't want to clutter everything up, but we're oversold down in here. We also begin to see the drying up of supply, time to cover shorts and exit our trades. Okay, just wanted to go through the background conditions there. So a little later in the day, we see that the noon hour didn't produce much. We had some decent volume coming in here, but it couldn't get us up to yesterday's high, signaling weakness. And then look at what happens. After that rally up, look at, we come down, and this is, again, supply overcoming demand on the Weiss wave. Again, the Weiss wave measuring the volume on this wave down rather than individual price bars. It aggregates the volume on the wave, making it very useful for us and very easy to read. With the weak rally, with selling in the morning and then a weak noon hour rally, we're looking now for an opportunity to get short again. And one comes up right around just before 2 o'clock in the afternoon. We get a small, after we get this drive down with the increase in downside volume to B, we get this small little rally, and I put it in small letters, little a, little b, little c, a nice key reversal at C, triggering our entry for the afternoon sell-off. And I'll pick up in a moment here. Okay, the market sells down. We don't get tremendous volume to the downside coming out, but the market does pick up a little bit of volume here and then starts to rally. So we're interested in that rally coming up. We push up into resistance here. This is old support that turns into resistance when we revisit it. We have a small low here, a small reaction at B, and then we rally up to C. Now notice that we have high volume here, but we're not going anywhere. We still get that key reversal. We get closes underneath. In fact, it's like the market tried to push up and didn't, and then on the last bar here did do the actual upthrust. So this is an upthrust into resistance, local resistance from earlier in the day. And when we're making lower lows here, lower highs. We couldn't come up to yesterday's high, lower low. That's a very nice trade setup. We enter there and then bang, we go right into the end of the day and then cover our shorts at that point. So that's a pretty nice way of trading a trend day to the downside once it gets going. Just by using the upthrusts as they set up intraday, they can be just lovely ways to trade. You don't need to really do anything else. Let me show you something on a larger time frame with an upthrust. This is a weekly continuation chart of crude oil. We can see that not only do upthrusts occur on the 5-minute chart or the intraday charts, but they occur on the weekly charts and the monthly, all time frames. So let's go through this and take a look at the price action as the upthrust is taking place. So we make a low here at A. You can see the volume is a little bit lower than what we had seen before, suggesting that supply is not dominant here or trying to exert control. Therefore, the buyers step in the very next bar and push the market up. Notice what happens at B. We come into a little bit of resistance here, and we get a slight pickup in volume at B, and then again at C. We try to rally up, and bang, we come down. And C in particular shows that resistance, shows that selling coming in. Now, definitely buyers are holding the market up, but sellers are having an impact by closing it down near the lows on increased volume. We'll see what happens with that now as we move forward. Next bar, D, pushes up. Again, we get pretty good volume. You would expect that at this point maybe we would push up above that resistance. We don't, so it's questionable. You know, there's a lot of volume coming in and we're not moving up. So we've got a couple of bars of selling coming in, and then what we would call a lot of effort to go up with good volume. Not a great result. Now the key bar here is bar E, or weak E. Now remember, this is a weekly bar. What does this tell us? We have volume here that's less than the prior couple of bars, narrow range, it's closing up, but this is suggesting that demand coming into the upside is falling away here. The very next bar, F, shows supply coming in, and especially on G, we see a lot of supply coming in. Why do we see supply coming in on F? Because it does push up and close above the old swing high here. But what happens? Yeah, we push up, so buyers came in, but then sellers stopped the market from going up and they drove the market down to close it here. And there was a pickup in volume. So we know that sellers were trying to enforce their will here. The very next day gets a very weak rally. We don't even go up to the old high. I'm talking about bar G now. And then we come in and close underneath. So this is the upthrust right here on the weekly. And you could short that on the close of the week, or you could wait next week, go to the daily chart and look for a weak rally up. That would be a test on the daily for entry. But either way, you would find you'd be in the market somewhere in this area with the objective of taking out the last swing low, and boy, do we do that in spades. We can see all the way down. There's just no relief to the selling pressure, the sell-off on this market. Now I want to point a couple of things out here. Upthrusts in general are not the best on a rallying market, in an uptrend. So here we make a swing high back in 2018 here, the beginning of 2018 it looks like. Then we push up through, and then we make a low, a swing low, and then we push up through it. How come this isn't an upthrust? Well, because we never close underneath that old swing high represented by the red line here. The market just continues to go up. So there's no upthrust here. Now at B, a little bit later in this chart, we do get an upthrust. Why didn't I highlight this as a tradable pattern? Well, we can see why when we look at the price bar action on the way up to B. Bar 1, strong bar up. Look at the volume coming in. Look at how we go underneath the lows of the prior two bars. Find no supply down there, and buyers, seeing that there's no supply, step right in and push the market up, closing it firm on high volume. Same thing on bar 2. We get hardly any pullback, and we get that drive up this week on very strong volume. This is not the kind of action we're looking for when we are looking to make an upthrust. What we're looking for is this. We see a little bit of supply coming in here on B and C with the high volume and the poor closes, and then we get the no demand up here at E. These are the kinds of, they're subtle signals or subtle symptoms of the market, signs and signals, but these are what we're looking for. And then we get the confirmation here on F and G. And even had you gotten short, say, on this bar, because we do have a bit of volume coming in, you might have thought, okay, well, maybe this is just stopping volume or some sort of other thing going on in the market that the sellers are coming in on, which it's not, but you might have thought that. Anyway, you can see we're just not going anywhere. So you'd get out of this, you'd scratch out of the trade somewhere in here. As you can see, the market just doesn't have any selling pressure to the downside. So let's go back to the intraday, and this time a 5-minute chart, and this is in the middle of the, looks like the European session is starting here. Yeah, we're in the European session here. And the first thing to notice is the condition of the market. We're making lower lows and lower highs, and as we do, we see volume being drawn out to the downside. So we make a low and a high. We don't know what's on the left-hand side of the chart, but we get a lower low and then a lower high and another lower low. And as we're doing this, we're seeing the supply overcoming the demand. No demand here. And supply overcoming demand. Notice that we get a little bit of no supply here and the market rallies up. And notice that as it rallies up to D, look at what happens to the demand. The demand, there's just no demand here. Very light demand. And it creates an upthrust situation on the intraday and a perfectly fine upthrust situation. We've got lower highs, lower lows in the background. No demand after selling has come into the market via an upthrust, a picture-perfect way to trade. And our objective, of course, is to take out the low of C, and we do that without any difficulty whatsoever. Now we'll take a look at a 5-minute chart without the Weiss wave, just regular volume. And this is a typical kind of situation in day trading situation where we see supply coming into the market. These closes are very poor, sellers are driving the market down. We have that reaction, we make a support, we find some support, rally back up. Look at the volume coming up on the rally. It's down, and we get a very poor price action to the upside here, upthrusting the pre-market and early U.S. market, right around 10:15, excuse me, the time when we often see inflections. Now, coming down, look at the wide spread. I've highlighted these bars here and here and here. The wide spread down, closing on the lows, closing poorly here. And as we come down on these bars, volume picks up. That's supply, that's selling. So we don't have the Weiss wave to measure the wave, but this would show a large down wave in volume. But you can do it with normal or standard price bar and volume bar. And all of that supply that we see here, that we just discussed on this rundown, sets us up for the next short trade. Market rallies back up. You can put in a trend channel if you like, but you can see that we make that little A, B, C, and we get this heavier volume coming into the downside, and our trigger, actually either one of these can be the trigger, would be a trigger to short on. And our objective, take out the low, and look at, as soon as we do, we see the volume come into the downside, volume coming into the downside, volume coming into the downside, and so on. Now here's a situation that a lot of traders find challenging, to say the least. Here we are at 9:25 Eastern Time, just moments before the U.S. Open of the S&Ps, where we know volatility can pick up and the market can just take right off right from the open. So how do we deal with this? Well, looking at the higher time frame chart, the hourly chart for this day, ending right at the exact same time, look at what we have here. We rally up into the overnight, and even though it's the overnight, meaning the Asian and European session, there's still no demand up there. We can see it in the narrow price ranges and the very low volume. Come up into the what I like to call the pre-market, which is maybe the hour or so, hour and a half before the U.S. Open. So around 8:30 to 9:30 in the morning. And here we are at just before 9:30, and we have an upthrust occurring on the 60-minute chart with really good volume characteristics. So we want to go back to the 5-minute chart and look for an opportunity to short. And we notice that supply has come into the market here and here. We've just had very poor flow to the upside. We haven't been able to continue the rally for however many minutes this is, 20, 40, almost an hour's worth of time here, 45 minutes to an hour. So there's a short right there. And that short comes not because of the supply we see on the 5-minute, but that short is triggered because of the 60-minute upthrust. The market starts to fall. We get another opportunity here, a no demand bar to enter on. Not maybe the best entry, but certainly an entry. A better entry is right here. We break down through the support from the early morning, the pre-market period. That should now be resistance as the market tries to rally back up through. And it is, and you can see there's a high placed here, put in here, and this bar goes just a little above it and then closes underneath of it on basically no demand. This is an upthrust here and also a spot to short, and a very good one because we're against resistance. Our objective is to take out that low, and we certainly do that very nicely. And we do that very nicely because we are trading really the 60-minute upthrust, not a 5-minute upthrust. We're using the 5-minute to enter the 60-minute upthrust. So that's a very nice trade setup. You can apply this weekly and daily, looking at, instead of a 60-minute upthrust, look for the weekly upthrust and use the daily to enter on, or the 240-minute chart. You can do all kinds of cool things like that with multiple time frames. We've covered a lot of ground in this short video. We certainly have talked about upthrusts and the ways that they can emerge in the charts. We've spent a lot of time on background conditions, the obvious stuff and the not so obvious stuff. That's important to understand. Some of the subtle things are reading price and volume, which we did both in terms of the Weiss wave and also in terms of normal price bars and our normal volume. We talked about entries, using that key reversal bar as a good entry. We talked about targets and exits, when to exit. We talked a lot about supply and demand and how critical it is in trading the upthrusts. We talked about how to read supply and demand, not just in the price bars, but also through the Weiss wave volume and in normal volume. Really importantly, we talked about multiple time frames and how to use multiple time frames in trading upthrusts. And so before we end, I just want to give you a sort of conceptual overview of the reliability of upthrusts. Upthrusts are going to be most reliable, meaning that they're going to work out to target. They're going to be most reliable in a downtrend and after supply has entered the market. And they're really good, as we saw in a couple of examples here, when we can see an upthrust occur against resistance. We saw a 60-minute upthrust occur, and we could trade it off of a 5-minute chart, but we also saw either a 3,000 tick or a 5-minute chart setting up an upthrust against yesterday's high resistance. So that's an example of the higher time frame resistance. They become less reliable when the supply starts to diminish, especially on the waves. It's a very good leading indicator for a turn in the market. When demand has overcome supply, we saw that on the weekly chart with crude oil on one of the examples where we saw an upthrust, but demand was clearly in control and we wouldn't take that upthrust. And of course, when we're in an uptrend, the market typically can go pretty far and typically does go pretty far in an uptrend. So these are some general ideas on the reliability of the upthrust. So I want to thank you for watching this video. If you would like to learn more about this trading method, the Wyckoff method, and would like good practice with it, would invite you to join us for our weekly deep practice sessions that occur on Thursday evenings but are recorded and available to you after the session is over. And in deep practice we would walk through charts, trading them on a simulated basis, looking for upthrusts and other trade setups out of the Wyckoff playbook. So I hope to see you in deep practice.